So I just want to say thank you for taking your time to come to these 5-minute-ish Fridays. It truly means a lot to me. Just so you know, for new people, I might do these 5-minute-ish topics. Sometimes they last, 5 minutes, sometimes, 15, 20, 30 minutes, really depending on, if I had any questions or, just like the topic and things like that. But today it shouldn't really be all that long. Today I'm just going to talk about how to generate steady cash flow with mortgage notes. And just real quick, I am not a financial planner or CPA. This video is for educational purposes only. This is not investment, tax, or legal advice. Please consult with a qualified professional for advice. This is just what I'm doing in my business, and your mileage may vary. Just always, anytime somebody gives you any type of advice, just vet it. Also check with your qualified professional. So why mortgage notes? They're predictable monthly income. They're backed by real estate, not the stock market swings, the ups and the downs, the volatility of the stock market. I got out of the stock market a little while ago, and I just prefer to invest in mortgage notes. You're the bank. You're no longer the landlord. You're also what's known as the lien lord. So you actually become the bank where the borrowers are actually paying you with these mortgage notes. I absolutely love them. Why notes over rentals? Notes create cash flow like rentals, but without the headaches. No tenants, repairs, or late night calls. I had, at one time I had a lot of rentals, and I just slowly made the migration over from rentals to notes. Each person has different assets that they're happy. With the rentals, you get appreciation and also depreciation. With the notes, you don't. But you don't get the headaches of having rentals with having notes, right? So there's trade-offs to both. So, it really boils down to what you're comfortable with. I still get paid every month. So what is, just the level set, what is a mortgage note? It's a legal promise to repay a loan. Basically, it's just an IOU, right? You buy the debt, not the house. The mortgage is the security instrument that puts that lien on that house. So that's what you use to foreclose. So if the borrower stops paying, you can foreclose on that mortgage to take that property back. So the borrower pays you just like you used to pay the bank. One note equals one paycheck. So as an example, you buy a $50,000 note for $35,000. The borrower pays you $400 a month, like clockwork, for the next 180 months. You collect $480, $4,800 per year from the 400 times 12. You collect 4,800. Your yield for buying this note at $35,000 is going to be 11.10%. And this is secured by real estate. Now, this is the gross yield, not the net yield. So in this particular case, this is actually a note that I did buy. And this is my net yield, 11.10%, because that note that I bought in the promissory note, it had the borrower paying servicing. So you have to make sure when you buy these notes, you have to read over all the documents to make sure you know who's paying what and when. So because this will, if the borrower didn't pay the servicing fee, so really, if they weren't paying it, my yield probably would have been like maybe 9-10%. Still not bad, but in this particular case, it's 11.10% return on my money. So how monthly paychecks scale? So just imagine if you bought 3 of these notes, invested the 35,000, 105,000. So the 3 notes times 4. $1,200 a month. 5 notes, if you bought times $400 a month, it would equate to $2,000 a month. And if you purchase 10 notes at $400 a month, that would equate to $4,000 a month. So that's a pretty nice little, chunk of change that's coming in. Now, obviously, depending on whether you're buying these within your self-directed IRA, tax-free versus tax-deferred, Roth, or a self-directed IRA. Or if you're using private money, you have to account for that. Or if you're using your money, you also have to account for time value of money and and taxes and things like that. So that's why I always talk about you have to talk to your financial planner or CPA to help you to make sure that you're help offsetting some of these costs, or that you're properly paying your taxes with this. So, but that's how it just scales. You can just go from 3 the 5 to 10 notes. Same deal structure, just multiplied. And why does it work? It's predictable income, passive income once it's set up for the most part. So a lot of people say that it's truly passive, and it's not. You do have to do some work. It's very minor work, meaning that you typically what I do is once a month I just log in to the back end servicing portal just to look, just to make sure that the payments are actually being made. If there's any issues coming up, that way I can address them before they actually become a problem. Notes don't call you when the AC breaks. That's one thing I absolutely love. I'm not getting the midnight calls like I once was getting when I owned a bunch of rentals. And your capital's working harder with fewer moving parts. So here's an example of scaling a note portfolio. Year one, I mean, it's really simple. Year one, just start with 1 to 2 notes. I mean, just imagine that 1 to 2 notes, right, at $400. I mean, it could be more, it could be a little bit less. I would encourage you not to get anything less than $250 a month with the monthly payments, just because you have to account for servicing, and then once you account for servicing, then it really kind of eats into your profit. So just be careful with that. And basically, what you do is with that 1 to 2 notes, you reinvest the cash flow and the savings, and then year three, you buy between 5 to 10 notes, and then your monthly income grows as your portfolio grows. I mean, it's pretty simple to grow your portfolio once you understand the mechanics behind buying these notes, where to buy them, and things like that. So, what do you actually need to start? You need some capital. I would say you can actually go lower than the 25,000. I've purchased notes for as low as $4,500, and this was just one of these circumstances where it was right place, right time. An investor was looking to liquidate a lot of his portfolio. So, like I said, right place, right time. Does that happen a lot? Absolutely not. Like I said, I was just the right place. But you could buy notes, as low as $5,000. But if you have $25,000 to $40,000, it's going to do you a little bit better because there are more deals within this price range. One thing I was talking about earlier, you can use your self-directed IRA, tax-deferred or tax-free, depending on whether you buy them in a self-directed Roth or a self-directed IRA. And then if you're using private money, you obviously have to account for the money cost within when you buy these notes. Your servicer, they handle all the payments, so you got to account for that servicing fee. And then also do your due diligence. You typically, when I buy these notes, it really comes down to the 3 Ps: the people, the property, and the paperwork. Early on, if it's an early note, then yeah, I like to see their credit score. But if they've been paying for a couple years and my investment to value is about 70% or less, then the credit score doesn't really come into factor for me that much, just because they've shown a history that they've been making payments, right? But if it's early on, say 3 months have gone by and they've only made 3 months, well, their credit score and the down payment really matters on whether or not I move forward with that note. And then the property, that's where you have to order a BPO to determine whether that property is worth what that individual is saying it's worth, and then look at your loan to value. More importantly, your investment to value, how much you have invested with the overall worth of the property. Me personally, I like to be at least 70% of the investment to value, so that way, if anything happens, if I have to foreclose on it, there's a little bit of buffer, because it's not a matter of if things go wrong or when things, it's just when, or if they go wrong, it's when they go wrong, right? So just always do your due diligence. And lastly, the paperwork, just, you got to review that paperwork. If you don't know how to review it, basically looking at all the assignment of mortgages, the allonges, the assignment of beneficial interests, and then also the assignment of the deeds, whether you're buying mortgage deeds of trust or contract for deeds. Just, have some, if you're not comfortable reviewing that paperwork, have somebody review it for you. I mean, the cost would be minimal compared to what could potentially cost you later on down the road. And then a good note source, not Craigslist. You can a really good note source, real quick, is Paper Stack. They have really good notes, but with that, you have to do your due diligence on that, right? So just please take your time to do due diligence on the assets that you're looking to purchase. So, and some key risks to know: if the borrowers stop paying, you can either do a loan modification or foreclosure. I'm actually going through a foreclosure right now on an asset that they stopped paying, and then the taxes weren't paid, and I just put forced place insurance on the asset. So I'm actually, I just sent everything over this morning for the foreclosure. And what I'll do is I'll actually do another 5-minute-ish Fridays. I'm sure it'll be more than 5 minutes, because I'll actually outline everything, so that way you can just kind of see, from like soup to nuts with that asset. So, but that's the neat thing about it. It's if they do stop paying, and if you're leveraged right, then you can. It sucks. I mean, it's horrible having to foreclose on somebody. That's the last thing that I want to do. But unfortunately, these borrowers, they're burying their heads in the sands, and they're really forcing my hand with this. And like I was saying, that's the last thing that I want to do. But if you do do a foreclosure, you will get that property back. And then you can keep it as a rental, sell it. Me personally, I don't want to keep it. I just want to sell it, just because it's outside my state, or really outside my city. I don't want to be managing properties all over the United States. At one time, I did that, and it's not pleasant. I will never do that again. Another thing: hidden taxes or title issues. Check before you buy. Always, always, always order a BPO. Always order a title report. That way, an O&E, owners and encumbrance report. That way you can make sure that there aren't any liens on it. And you can even go one step further, call the county just to verify there aren't any liens. Just because the title report comes back saying it's clean, I had circumstances where the title report said one thing and the county said entirely different. So just always call the county. Another thing you could do too is call the utilities with that on that asset, just to make sure there aren't any other liens associated with that. So just always do your due diligence. And if you buy right, stay protected. And lastly, don't chase yield blindly. A lot of people just chase the yield. If they're just making above, I don't know, say if 12% is your yield, then it doesn't matter. I think that's a bad way of doing it. You have to look at the people, the property, and the paperwork, right? So and then for me personally, I want to be at least 70% ITV in order to protect my investment. So, all these things come into play, and I think that's where you're going to have to figure out your wheelhouse on this. So everybody has different things that they want to do. Some investors buy these notes where they have the intentions of just simply foreclosing on the property and not working it out with them. They want to take that property back because it's an early entry point before the foreclosure. So if they buy the note, they can instantiate that foreclosure and take that property back. So, you kind of have to know your exit strategy. Well, I would say you have to know your exit strategy before going into it, because that's going to dictate how you buy this asset. And that's really it. I don't know if there are any questions. I don't see anything. But if you have anything, always feel free to drop them in the chat. It looks like I had some issue with it coming up on YouTube. I don't know what's going on. I may have to re-authenticate myself there. But if you have any questions, just please feel free to drop them. You can shoot them to me, Larry at ljhinvestments.com, or you can just call me, 513-301-1468, or you can schedule a 30-minute call, talkwithlarryhoffman.com. Here, let me go back to here. Or you can just schedule a call with me, talkwithlarryhoffman.com, and maybe you have an asset you're looking at, a performing note, non-performing note. Just let me. You can see my dog in the back. Willow, her tail's coming up, but just shoot me a message, and I'll be more than happy to spend some time with you. Or if you're looking to put some of your lazy assets to work, building up your portfolio or just earning an above average return, just, schedule a call with me, talkwithlarryhoffman.com, and I'll answer any questions that you guys have. All right, I'll talk to you, and you guys have a great weekend. See ya.